This channel is for educational purposes only. Make sure you do your own due diligence before making any investments. And there is inherent risk in trading, so it's speculative. Just make sure you keep that in mind. Hi, this is Joe. We're going to talk about the S&P today. Probably just going to stay with the S&P because I want to just show a few things that have taken place recently with a slightly different look to the chart. And then I'm going to go show a specific trade setup that's played out here over the course of the last few days. So let's go ahead and get into things and start looking at this. So I've got this chart, and I've shown this chart in the past because what I like about it is this is a weekly chart with this purple line is the 18-week. And then the blue line is an 18-month line, essentially. It's not exact, but it's close. And then this yellow line or gold line is the quarterly 18. And so we can see, looking at it from a longer term standpoint, that we've made a pretty big move now, and the 18-month line is pretty far away from the quarterly 18, and now the 18-week is really getting stretched away from the 18-month. So I think we have to respect what we're seeing here. Now, as long as this trend stays up, I mean, look at how this keeps respecting this 18-week line. Until that breaks, then I don't necessarily wouldn't be looking to be any kind of like for any big down move or anything like that. But when I get into the momentum conditions, I think you'll understand, and what I've been talking about for probably about a month now, the conditions aren't quite as strong. And it's the reason why when you put this two together, right, we're getting a little bit overdone based on how far this is from this, and this line is from this line. And then if we got any kind of a push to the upside, then we have kind of all four. Price away from the 18, 18 away from the monthly 18, and the monthly 18 away from the quarterly 18. So if we get that, that would be another negative to be on the lookout for. However, based on the momentum, it's very possible we're just going to break this 18-week line and end up correcting back down. So that's really what I'm on the lookout for. And until that happens, I think you have to have an upward bias. And so you just kind of want to be aware of that. So that's kind of the backdrop. One thing I will mention, I'm not actually going to pull up the chart, but the sentiment numbers, the bull bear number went up to 40 last week, got up to 41, and then dropped down to 33 all in 1 week. So this week it's back down to 33%. So there are more bulls than bears, but we kind of dropped out of that danger zone pretty quickly. And again, when I see that, I'm less inclined to believe that we're in for a big drop right away. So anyway, I just wanted to give you an update on that. Let's look at the 4 time frames, and we can see how this monthly line, so this is a different view of the same thing I was just looking at. Look at how far price is getting away from the 18-month line. But what I wanted to do today is twofold. One is continue to harp on this problem that we've got, which is momentum has not been good. Now, the trend here using an 18-week and a 40-week is fine. So that's why I'm just not going to look to just sell just because of what I'm seeing in the momentum indicators, whether it be daily and weekly. However, what I will say is that because the hourly chart set itself up recently and we broke the trend line, the uptrend line, which had been in place since the beginning of August. So we make this move, we make a new high, and then we break the trend line, then we come up and test the trend line and look like we're failing. Look at what else happened. I'm going to zero in on this. So we broke the trend line, we rallied back up. We had red DI cross up above green DI, and then on the rally up, it held above 25. So that's not a bad condition there. And then also notice that the MACD was crossing down below the zero line, and we got a pinch play develop right there, right at the zero line. So this is a really good combination to be on the lookout for. And so when you see something like that, or at least when I do, and I know the backdrop of the momentum is not all that great, I'm willing to play this. And the way my partner and I typically do these type of trades, we will put on the puts, and we do puts that are like 2 to 3 weeks out. And
and we're not taking a huge risk, but we want to put on some protective puts to kind of hold for a hedge against our long positions. So instead of selling out of a bunch of longs, because we don't know whether we're just going to have another couple down days, just like we've had. Look at this: down day 2 or 3 days, down day 2 or 3 days, another 2 or 3 days, and now maybe this is just another 2 or 3 days. You never know. So I'd rather put up less money and at least put some hedge on, so that if the market does make a little bit more of a drop, we're pretty protected against a big drop. And then if it ends up breaking the 18-week and getting a little bit more severe, we're going to end up getting stopped out of some of our long positions. So at that point, we're going to be protected based on our individual trade management technique. So this is more of like sort of protecting against this initial thrust to the downside. And we do it again with some cheap puts that are out of the money. And, if they drop down like this pretty quickly, they make a pretty good little pop. And so look at what happened though. So first of all, let's finish off this trade. So we have the break of the trend line, and then we rally back up. So as this is rallying back up, you want to go down to your 10-minute chart. So I'm going to go here on my 10-minute chart. I'm going to blow this up. Notice what happened on the 10-minute. So we start a new day right here, at this where this vertical line shows up, and we get this opposing trend pattern to develop. Now it broke the trend line here. Let me put the trend line correct. So there's a trend line break. Now, it didn't really come out of the zone until 2 o'clock in the afternoon. It had this little pop that tested the high. So that was the 2. So the break of the trend line is 1, and then the coming up to here is test is 2. And then we came in the zone between the 18 and the 40, and then we popped out of the zone. And then look at what happened on the next bar. It came crashing down through both. So this is a type of situation where you have a couple options. You could short it right there, taking out that prior bar, coming back down through those 2 moving averages. That's one option. A second option is, because it was such a violent bar and it happened so quickly, maybe you wait for a pinch play to develop, which happened on the next 2-bar rally. You had a 2-bar rally here, and you could have put a pinch play on right here, taking out 443 basically for a pretty nice drop. And then just so you know, I mean, if you're going to put a trade like this on based on not hedging, but I'm talking about an actual trade where you're looking to make money on this type of pattern, and you get a quick run to the downside and a gap down the following day, I do suggest taking profits. If you don't take at least half of your trade off on this gap down, then I think you're making a big mistake. You want to take advantage of these short-term moves when you're trading off of a 10-minute chart. Use price expansion in your favor and take a pretty good amount of money off the table when you get these type of moves. So that is, I think, a pretty good example of how you can use these 2 time frames together. In this case, an hourly and a 10-minute. Now, I know a lot of you might be saying, I don't trade like that, and that's fine, and I'm not telling you to, but this is a great example of how to use the 2 time frames together, no matter what 2 time frames you're using. You can apply it to the longer term time frames when they show up, but you want to be able to recognize it on the smaller time frames when they take place. One other thing that I thought I would mention, actually, let me just look at this 10-minute real quick. So notice how when this popped up and then broke down, you see how the red DI did the same thing it did on the hour. It popped above the green and then held on the pullback. So that's a nice confirmation. We want to look at the DI lines when we're trading, and that will really help in terms of how we're looking at MACD. So use that, especially for pinch plays and stuff like that. If you're not getting this type of confirmation from your DI lines, then I would probably pass on a pinch play. I want to have the DI confirmation, even if the ADX isn't above 25 or anything like that. I want to make sure that the DI lines are telling me the same thing that I'm seeing from MACD. So just one point I wanted to make sure I made there. Now, we've pulled back, and it looks like we're trying to hold the 40. And again, look at what's taken place really since May. We had this down move, didn't have any follow through. Down move, didn't have any follow through. Another down move, no follow through. Down move, does it have follow through? I don't know. We'll have to see. This has not resolved itself yet. Let's take these lines off. This hourly chart came down, and now we're getting the ADX to work a little bit. The red DI was strong enough on that down move, but because it was a gap, and look at where it came down to. Came down to this prior support area and turned on a dime. These are the types of things, if you're a short-term trader, you need to be really good at recognizing where prior support is. And when you get an oversold reading like this, especially via a gap, you want to take advantage of them when they come across. Now we're rallying back up. The question is this going to become a trend, or is it just going to pop right back up through the 18 MA? And is the MACD going to cross up over? And then we're going to kind of break the back of the downtrend, and then it's going to maybe come back and test and then turn back up. I mean, we've seen this pattern over and over again. Or is it going to fail at the 18 and actually come back down through this 437.75? And if we do that, then maybe finally we're in for something a little bit more significant to the downside. So just stay tuned for that. That's really where we are right now. I don't think we want to turn this into rocket science. The 18-week is the key to the trend right now. No reason to pre-guess or be Superman or anything like that. Just wait for that to break if you're looking at this from a longer-term standpoint. All right, post any questions or comments. We'll see you next time.